The most dangerous document a man over 60 will ever sign does not ask him for money. It asks him to stop paying down what he owes, and in exchange, it lets him keep a little more cash in his pocket every month. He signs. He feels relieved, and from that day forward, he owns less of his own house than he did the day before he signed it. That is the interest-only mortgage. And if you are 60, 65, even 70, and someone in a nice office recently suggested you refinance into one to free up cash flow for retirement, you need to understand exactly what you agreed to. Because you did not lower your payment. You converted yourself, quietly, permanently, into a tenant. Let me tell you about a man named Harold. Harold spent 31 years as a maintenance supervisor for a regional utility company. He wore a uniform every day of his working life. He carried a pager before most people carried phones. He bought a modest 3-bedroom house in 1994 for $112,000, and for the next 22 years, he made every single payment on time. Not most. Everyone. He watched his neighbors buy boats and pools and second cars on credit, and he said no. He drove the same truck for 11 years. He packed his own lunch until the day he retired. By the time Harold turned 63, his house was paid off completely. No mortgage, no lien. No one could ever put him and his wife out on the street. That house was the one thing in his entire life that the world could not touch. And then a financial advisor, a young man with a nice watch and a nicer smile, sat across from Harold's kitchen table and told him he was doing retirement wrong. He told Harold that a paid-off house was, in his words, dead equity. He told Harold that a man with Harold's discipline could unlock that equity, refinance into an interest-only loan, and use the freed-up cash for the retirement Harold had actually earned. Trips, grandchildren, breathing room. Harold, a man who had said no to everything his whole life, finally said yes to something that felt, for once, like a reward. He signed the papers. His monthly payment dropped by $400. For about a year, Harold felt like he had finally won. Then Harold looked at his 10th statement and noticed something that made his stomach drop. His balance had not moved. Not by $1. He had paid the bank for almost a full year, and he owed exactly what he owed on day one. That is not an accident. That is the entire product working exactly as designed. Here is what you need to understand before you go one sentence further. An interest-only mortgage is not a mortgage in the sense you are raised to understand the word. A real mortgage is a slow, grinding war against a number, where every payment is a small victory, where the balance shrinks and your ownership grows, until one day the number hits 0 and the house is yours completely forever. An interest-only loan removes the war entirely. Every payment you make simply rents the bank's money for another month. The balance never drops. The ownership never grows. You can make that payment for 5 years, for 10 years, for the rest of your natural life, and you will die owing exactly what you owed the day you signed, which means you are not a homeowner anymore. You are a very well-disguised tenant, paying rent to a landlord who calls himself a lender in a house you were told belonged to you. Sit with that for a second, because the man who sells you this product will never once use the word rent. He will use the word flexibility. He will use the phrase cash flow management. He will tell you it is what wealthy people do, and that part is true, but he will leave out the reason wealthy people do it. A wealthy man uses an interest-only loan because he has other assets working elsewhere, and the house is one small piece on a very large board. You are not that man. For you, the house is the board. It is the whole game. And when the entire game is one house, converting your only asset into a permanent rental payment is not a strategy. It is a slow-motion eviction with a 15-year runway. To understand how this trap got built, and built specifically for men exactly like Harold, you have to go back to 2008. In late 2006, a man named Ray Kowalski ran a small electrical contracting business outside Cleveland, Ohio. Ray was 54 years old. He had built that business from a single van and a toolbox into a company with 9 employees. In 1998, Ray had paid off his home mortgage entirely, the same way Harold did, dollar by dollar, year after year, no shortcuts. By 2006, Ray's house was worth $240,000 on paper, and a loan officer at his local bank told him something that sounded almost identical to what Harold would be told a decade later. He told Ray that a home equity line of credit drawn against that paid-off house was simply smart capital. Fund the business. Buy new equipment. Keep growth moving. Ray signed for a line of $110,000, secured against the house he had spent 17 years paying off free and clear. For about 18 months, it worked exactly as promised. Ray bought 2 new work trucks. He hired 3 more men. His revenue climbed. And then, in the fall of 2008, without warning, without a single missed payment on Ray's part, his bank froze the entire line. Not reduced it, froze it. The letter said the freeze was due to a decline in property values in his area. Ray had done nothing wrong. He had made every payment. The bank simply looked at the collapsing market around him and decided his paid-off house, the same house that had sat as pure, unencumbered safety for 17 years, was no longer good enough collateral for money Ray had already been promised. Overnight, his working capital vanished. He could not finish 2 jobs already underway. He laid off 5 of his 9 employees within a month. By the spring of 2009, Ray had sold both trucks and was back to running the business out of a single van at 56 years old, starting over. Ray did not lose his house to a bad decision. He lost his business and very nearly his house to a system that had convinced him his equity was a tool to be used rather than a wall to be kept standing. The bank that froze his line faced no penalty. The loan officer who sold it to him had already moved to a different branch. Ray was simply the collateral damage of a machine that needed his equity flowing while times were good, and needed it locked away the instant times turned bad, and never once asked Ray what he needed. That is not 2 separate stories. That is one design, tested on 2 different kinds of men, 12 years apart, arriving at the exact same conclusion. Both Harold and Ray spent decades building the one asset that was supposed to be untouchable. Both were told by a calm, well-dressed professional that their caution was actually a mistake. And both discovered, only after signing, that the moment you convert paid-off equity into accessible or interest-only debt, you have handed control of your own home back to an institution that answers to no one but its shareholders. The mechanism is identical today. Only the names have changed. In 2008, it was home equity lines of credit and adjustable rate mortgages, sold to working families as smart leverage. Today, the exact same mechanism has been repackaged and pointed directly at you, the retiree, wearing a friendlier name. It is no longer marketed as a business tool. It is marketed as a retirement tool. Same structure, same interest-only design, same permanent rental relationship disguised as ownership. The only thing that changed is the sales pitch got softer and the target got older. Here is how the machine actually works, mechanically, because once you see the gears, you cannot unsee them. Picture a paid-off house as a locked vault. For decades, that vault sat closed. Nothing came in, nothing went out, and nobody but you had a key. The interest-only mortgage does not break into that vault. It hands you a key of your own and tells you how convenient it is that you can now open the door whenever you like. What it does not tell you is that the moment you take that key, the bank quietly installs a second lock behind the first one, and that second lock belongs entirely to them. You can still walk through your own front door every day. You can still mow your own lawn, host your own grandchildren, sleep in your own bedroom. But the vault behind the walls, the actual equity, the actual net worth, now belongs jointly to you and a lender, who has no obligation to ever let that balance shrink unless you force it to. Here is the part that should make you angry. The bank is not confused about what is happening. The bank has calculated, to the decimal point, exactly how much profit sits in a retiree who takes an interest-only loan and simply keeps paying it month after month, year after year, until the day he dies or sells. Every single payment you make is 100% profit for the lender, with none of it reducing what you owe. You are not slowly buying freedom. You are slowly funding someone else's retirement using the house you already earned once. Let me introduce you to a second person, so you understand this is not one unlucky man's story. Her name is Diane. Diane spent 29 years as a hospital administrator. She never touched her home equity, not once, through 2 children's college educations, through a divorce at 51, through every hardship life threw at her. At 67, 3 years into retirement, Diane sat down with a reverse mortgage counselor who suggested, gently, that an interest-only structure attached to her equity could supplement her fixed income and let her stop worrying about the numbers every month. Diane, exhausted from decades of budgeting every dollar, agreed. Where Harold was punished for having 0 debt and being told that was inefficient, Diane was punished for trusting the very institution whose entire job title included the word counselor. 2 different doors, 2 different sales pitches, the exact same room on the other side. Diane is now 71. Her fixed income from her pension covers less each year because the cost of everything around her keeps climbing while her check does not. Her interest-only balance has not moved, and every year that passes, the equity she spent 29 years building shrinks a little further against a house whose value she can no longer count on to outpace what she owes. She's not behind on a single payment. She has done nothing wrong, and she is, in every meaningful sense, renting a house she was told she owned outright. This is where you need to hear the part that ties everything together, because it explains something far bigger than one mortgage product. The reason this specific trap works so well on men and women exactly your age is that your entire generation was trained to trust the wrong signal. You were taught that a calm voice, a nice office, a fiduciary-sounding title meant safety. You were taught that debt was something reckless young people did, and that a mature, responsible person simply followed the advice of the professional across the desk. Nobody ever told you that the professional across the desk is paid, directly or indirectly, based on which product you choose, and that a paid-off house sitting quietly in your name generates exactly $0 of revenue for anyone but you. An interest-only loan, by contrast, generates revenue every single month, forever, for someone else. The advice was never neutral. It only sounded neutral, because neutral is what a good salesman sounds like. You worked your whole career under one simple rule. Show up, do the job, get paid. You assumed the financial system operated under the same honest rule. It does not. The financial system profits most not when you succeed, but when you remain permanently, quietly, invisibly obligated. A paid-off house is the one place in your entire financial life where that obligation ends. That is precisely why an entire industry exists, to convince you gently, respectfully, in a nice office with good coffee, to reopen it. So what do you actually do with this? Not a script, not a checklist. A question, and it is the only question that matters now. When you look at your own house, do you see an asset that belongs to you? Or do you see a monthly payment that happens to have your name attached to the title? Because those are two entirely different lives. One of them ends with a piece of paper that says, paid in full. A piece of paper no court, no bank, no downturn can ever take back from you. The other one ends the way Diane's will end, and the way Harold's almost did, with decades of discipline slowly bled out one interest-only payment at a time, until the balance you started with is the balance you finish with. And the only thing that changed is how many years you have left to keep paying it. Harold got lucky. 18 months after he signed, his daughter, an accountant, looked at his statement over Thanksgiving and asked him a question nobody else had ever asked him. She asked him how much of the balance he had actually paid off. Harold could not answer. When they worked it out together, and he understood the truth, he refinanced back into a standard, boring, ordinary principal and interest loan. It cost him closing fees. It raised his monthly payment. And it was, in his own words, the only way he could sleep again. Today, 4 years later, Harold is back to doing what he did for 22 years before anyone talked him out of it. Every payment he makes takes a bite out of the number. Every year, he owns a little more, and the bank owns a little less. He is 67 years old, and for the first time since he signed those papers, he is not renting his own life back from a stranger. Diane has not made that call yet. She is still deciding whether the fees to unwind it are worth the peace of mind. Maybe by the time you hear this, she will have made it. Here is what nobody in that nice office with a good coffee will ever say to you directly. A man who owes nothing needs nothing from the system, and a man who needs nothing from the system is the one man the system cannot control. That is not a coincidence. That is the entire reason paid-off equity gets targeted first, before the car, before the pension, before anything else you own. It is the one piece of you that was already free. Own it outright or rent it forever. There is no third option, no matter what the brochure says. Choose the number that shrinks. Choose the debt that ends. Choose the door that locks from your side, not theirs. The house was never the trap. The paperwork was.